Hello, Brian Turner here again, bringing you another mortgage video installment. Today we're going over the 11 essential tips you need to know when applying for a mortgage. If you can follow these steps and learn them, you can avoid a lot of disappointment and save thousands of dollars when you purchase a house or refinance your existing mortgage. So without any further ado, let's move on and get on to it. Number one, know how much money you can put down. It's really important before you get started in the process to figure out how much money you have available to complete the transaction. You want to not just think about how much money you can afford, but you need to think about what you can put towards the down payment and the closing costs. You know, a lot of times people don't realize that you're going to have $3,000 to $4,000 in closing costs no matter who you go with for your mortgage. So it's a good thing to think about that, and always keep in mind that the more money you can put as a down payment, the better rates and terms you're likely to get. So keep that in mind, but also keep in mind that you want to stay within your means. You don't want to bust your budget trying to do this. So if you talk to a good mortgage person, they'll be able to give you all the options and let you know what you're dealing with. So number two, work with a reputable mortgage banker. One of the most common reasons that a sale fails is that the mortgage fails to go through. So, ask a lot of questions of your mortgage broker. Do they sound like they know what they're talking about? That kind of thing. Ask them if they have a service guarantee. A lot of times they'll if you give them a certain amount of information and that kind of thing, they'll guarantee that they're going to call you back in certain periods of time and that kind of stuff. So ask about that. Number two, work with a reputable mortgage banker. Number three, make sure you understand the process. You want to work with a mortgage banker that's going to take the time to answer the questions and break things down, in terms you're going to understand. I like to say, dumb it down for you. It's kind of a joke, but it's true. You want someone who, doesn't mind if you ask 100 questions and doesn't think any of your questions are stupid. You're looking for a mortgage banker that's got the heart of a teacher. So keep that in mind. Number three, make sure you understand the process. Number four, work with a lender that has multiple investors. A lot of people don't realize this, but not all lenders are created equal. Some of them are only working with one investor and only have one set of guidelines. Whereas other mortgage lenders are going to have multiple investors to work with, and what that means is if you're working with one that just has one investor, they might not have the loan program that you need. So it's important to ask if they're working with multiple investors. And another reason also is a good point is that if you need to change loan programs midstream, say for instance you have you're going to do an FHA loan, but then the appraisal doesn't, the house doesn't qualify for FHA, and you got to switch to conventional midstream. You want a mortgage banker that can make that switch without having to start the process all over. Things that can happen, like say you've already paid for the appraisal, which is $400. And you find out you got to switch to a conventional, but the person you're working with can't help you there, and then you got to go somewhere else. Well, then you're looking at paying another $400. So it's if you ask these questions up front, it can save you a lot of money down the road. So number four, work with a lender that has multiple investors. Number five, don't make large purchases prior to application. A lot of people think it's a good idea to get go ahead and buy the car or get the boat taken care of before the application. The thing is that your monthly payments are a key component in determining how much house you can qualify for. So you have this thing called a debt to income ratio, and so they use that, and they took your whole total monthly payments and they look at your total income and they come up with how much of a mortgage you can qualify for. So if you have an extra car payment in there, it's going to be less house that you can qualify for. So it's really best to wait till after you purchase the house and you've closed before you start buying things like cars, boats, big ticket items. So anyway, don't make large purchases until the house is done. Number six, over shopping your loan. Certainly understandable. You want to check around, you want to talk with different people and kind of get an idea. One thing to just keep in mind is, every time you go to a different lender, to try and get the best terms and everything, you're gonna have to get your credit pulled again. And every time you get your credit pulled, your scores can drop. And a lot of times people think, well, I got a 750 credit score, my score's good, it doesn't matter. But and prior to the mortgage meltdown years, that did make a difference, and it wasn't too big of a deal. But now they have these, and this is at the Fannie Mae level. So every bank's going to have these adjustments. If your score falls below a 740, you're not getting the lowest rate possible. So just keep that in mind. They have these things called risk-based pricing adjustments, and every 20 scores. So at 740, you get a lower interest rate. At 720, you get rate goes up a little bit. So, if you let your credit get pulled 5-6 times and you lose 30, 40 points, it can cost you a quarter, 3/8 of a point on the rate. So keep that in mind. If you go with, and lastly, if you go with another lender, a lender that has multiple investors, going back to that point, they can pull your credit once and shop around with all the investors and kind of go over all the stuff with you. So you can kind of get your credit pulled once and, still check with everybody. So it's something to keep in mind. Don't overshop your loan. Number 7 is don't hide things from your mortgage banker. Everybody's fallen on hard times in life. It's believe me, in working 11 years in mortgages, I've seen it all, and you'd be amazed of what a lot of people have gone through. And a thing to remember also is that every part of your financial history is going to be verified. They're going to pull, if there was any bankruptcies, foreclosures, collections, judgments, any of that kind of stuff on your credit in the past, it's going to be found out. So you're best to tell your mortgage person up front, and just remember that your mortgage banker's there to help you. They want to get your transaction closed, so it's better to give them the whole thing. I usually tell people, give me the sand, let me make the castle, and it's just basically, I know how to present your loan to underwriting, but I got to have all the facts before I can do it. So, make sure you tell your mortgage person the good, the bad, and the ugly. And believe me, if they've been doing mortgages for any amount of time, whatever your story is, they've heard 10 times worse. So just go ahead and give it all to them. Number 8, I know this sounds silly, but pay your bills on time. I guess everybody knows that, but late payments, especially in the 12 months leading up to your mortgage, like to buying a home, those 12 months are crucial, and they can really give you keep you from getting the best rates and stuff like that. And also they can cause you to maybe not get approved at all. So I know this sounds silly, but just always pay your bills on time. All right, number 9, overusing your credit cards. I have credit cards. They are convenient. They're not like evil, but you just want to, keep an eye, make sure you keep your balances low or keep the thing paid off. Again, this goes into, if you're running high balances, A, it can pull your credit scores down and give you higher interest rates. But B, if you got a big credit card balance, that means you got a big monthly payment. And then that's got to be included in your debt ratio and could affect how much home you get approved for. So keep that in mind. Keep your balances low or paid off. And it will, just make sure that you're going to get the loan that fits your needs. So, number 10, this is a biggie. Co-signing for someone else's loan. I can't tell you how many times I've seen this, and it's such a huge headache for people. You got a cousin or a daughter or a son or a friend that needs help, and you want to help them out, but you got to think about this. In certain situations, if you co-sign for them, they have to have the loan for 12 months and be paying it out of their account, or we have to count that payment in your debt ratio calculation. So it can affect how much house you can buy in certain situations. And then, another thing to think about is if they don't make the payment on time, or if they make late payments or something like that, you're stuck. You have no, that payment counts against you. You co-signed for the loan, you're partially responsible. And if they don't pay the whole thing, you might end up being, if they walk away from the loan, you may be on the hook for the whole obligation. So just think about it. I don't recommend doing it, but if you are going to do it, I definitely recommend you give it some thought and really consider whether it's the best idea. So that's it. Number 11, get all the facts up front. You want to learn about the total closing costs on the loan up front before you start, not just at closing, but also for the whole life of the loan. Any mortgage person you work with or that is worth their salt is going to provide you with a good faith estimate as soon as it'll take maybe within 2 or 3 days, but they'll get you a good faith estimate, and that's going to give you all the costs at closing. That's going to go through, the attorney's fees. Well, it'll be an estimate of the attorney's fees, homeowners insurance. They're going to know their fees. They'll probably have the appraisal fee worked out. So you get an idea what the whole cost is going to be. Plus, it'll have the interest rate, your monthly payments, the whole thing on that good faith estimate. You can also look at the truth in lending. That is a thing that'll give you a idea of what the loan is going to cost for the whole life of the loan. So you should take a look at that. Especially if you're comparing, if you're comparing loan products, there can be subtle differences in a loan that can make them cost you thousands of dollars more. So just and it's you just kind of need to make sure you got all the facts and you know what you're talking about. So at any rate, that's what we're looking at. That's the 11 essential tips you need to know when you're applying for a mortgage. I hope you found this helpful, and I'd love to hear any feedback, comments, or suggestions. And that's it. Have a great day.